retirement, you can totally control your taxes. You're no longer subject to getting a W-2, which you can't control that. You want to make as much as you can. It all gets reported on a W-2. When you're retired, and let's say you have just investment accounts now, maybe Social Security. Very few of us have the benefit of having a pension any longer. So now you can do a lot with tax planning. It's important that when you plan ahead for retirement that you start out 20 years before you retire. One of the biggest mistakes I see a lot of people make is put all their money in 401ks. Well, you don't have a lot of tax. Once you retire, well, any income you need, you're going to get a 1099 for. You have no planning opportunities, okay? But when you retire and you have after-tax accounts, investment accounts, you have money in the bank, you have Roth accounts, you have IRAs, now we can do a lot of fun things, okay? There's certain things that you can qualify. If you're under 65, you need health insurance, right? Well, I can show you how to control your income, your modified adjusted gross income, so you can get your health insurance paid for by the government. Great, right? So people used to have to work till 65, no longer have to because they couldn't afford, they didn't want to pay for the high cost of insurance. Other things you can do. You want tax-free Social Security, I'll show you how to do it, okay? There's tools out there, depending on what kind of accounts you have, we can make it so you have very little income on your tax return and you don't have to pay any taxes on your Social Security. Those are just a couple of examples. Required minimum distributions, minimum required distributions, there's different ways of saying it and there's different acronyms for it, same thing. There's been some changes to that over the last several years. It used to be age 70 and a half, you had to take the money out. Now it's age 73, so they've delayed it a little bit. Even though they're delaying it a little bit, it just means you have to take out a little more later, right? But that's the amount of money you have to take out of your IRA at those ages. So the IRS isn't going to let you keep your money tax deferred forever. So you have to take required minimum distributions. And when you pass away, your beneficiaries have to take required minimum distributions as well. And that could be even a bigger challenge and a bigger problem. And with good planning and planning ahead, you can look at that and take advantage of the tax laws as well. If you have money in a Roth, okay, now you have the ability to take money out of a Roth and that's tax-free. So that means now other things like Social Security, which is tax-free unless your income's too high, you can maintain the tax-free status of your Social Security by taking money out of a Roth. So by converting money from an IRA to a Roth for a few years, then that means for another few years down the road, you can have a lot lower income and avoid taxes completely if you want. So there's a lot of things you can do when you have money in a Roth. So it's important that you get money. If you don't have money in a Roth, it's important that we talk about converting money to a Roth so we can do tax planning in the future as well. When you take money out of your IRA accounts and you are familiar with the tax brackets, marginal tax brackets, 15, 22, 24% tax brackets. So we want to make sure we can control your income, and that means not bumping you up to the 35% tax bracket, not bumping you up to 24. So by taking just the right amount of money out, we can keep your taxes to a minimum. Health savings accounts are a great way for you to put money away for the future, for health costs. So everybody's concerned about high cost of healthcare during retirement. If you have money in a health savings account, that money grows tax deferred, and when you take it out, it comes out tax free as long as you use it for healthcare expenses. Tax loss planning is just looking at your positions and being able to take your losses, and losses offset gains, right? And if you have more gains than losses, obviously you're going to pay taxes on the gains. If you have more losses than gains, this is where people kind of get upset because you can't write off all your losses, unfortunately. You can only write off $3,000 a year against ordinary income. So yeah, it's good that you're writing it off against ordinary income because ordinary income tax rates are higher than capital gains tax rates, but you're only limited to $3,000. So it's not too much to get too excited about, but it can help. For clients that are in the highest tax brackets, municipal bonds can make a lot of sense. The problem is for most clients, municipal bonds pay such a low interest when compared to taxable bonds, it doesn't make sense. So you just have to be aware of your tax situation. So maximizing your Social Security benefits as a tax saving strategy is about income planning. Once again, controlling your taxable income. Because the lower your taxable income is, the less likely it is you're going to have to pay taxes on Social Security. So that's one of the most important things. Even things like municipal interest come back in and affect how much your Social Security is taxed. So people aren't always aware of that. Other things are, when it comes to Social Security planning, people always want to know what's the best age to take Social Security. And this is more of a financial planning thing. And the answer I always tell people, well, it really depends on you and your situation. There's no right answer on that. How long are you going to live? Nobody knows. Nobody has an expiration date. But when I do strategies that maximize Social Security benefits, and you wait to age 70, which is the maximum age to take Social Security benefits, is when you max out your benefits, well, you better live into your mid-80s to come out ahead. And that's generally the rule of thumb. So someone is 62 years old. They're not old enough yet to get Medicare. They're concerned about the high cost of health insurance premiums. They need $90,000 to live on these days. So what do you do if you want to qualify for health insurance credits? Well, there's tools out there that can allow you to get cash flow of $90,000 a year and still get your health insurance covered by tax credits. So that's one really exciting thing that I'm able to help clients with. Right now I'm working on a case where a client really wants to retire. He's aches and pains, and he doesn't think he can do it anymore, right? So we're able to get him health insurance paid for by taking money and putting it into what's called an immediate annuity that pays out for 5 years. Now that payout for 5 years, that money makes 4% while the insurance company pays out that annuity, but only 10% of that cash flow is considered taxable income. So he gets a big cash flow with a very low tax bill, and even with his Social Security counting towards the modified adjusted gross income, he's able to get the tax credits to pay for his health insurance, which is pretty exciting.